Hello and welcome to the March 3rd, 2023 episode of Watching the Tape. Cash earns nearly the same as the S&P 500. That is the headline anyways, so let's break that down. Here is the chart from Bloomberg illustrating the yield on cash and the yield on the S&P 500 going all the way back to January of 2000. You can see that the aqua line, which represents the cash substitute for the purposes of this chart, has risen sharply recently to be in line with the white line, which is the earnings yield on the S&P 500. So first, a word on cash. This is not the cash that is sitting in your bank. So the cash in this case refers to the yield on short-term government bonds, specifically the yield on the 6-month Treasury bill. That's pretty straightforward. The less straightforward part is the earnings yield on the S&P 500. And I'll tell you what it's not. It's not the dividend yield. So the dividend yield on the S&P 500 is about 1.75%. And that's calculated as the dividends over the last 12 months divided by the price of the S&P 500. All right, so companies don't pay out all of their earnings in the form of dividends to shareholders. So the earnings yield in the chart that we looked at is earnings per share divided by the price of a share for all the companies in the S&P 500. And so as a shareholder, you will receive income from dividends, but the remainder of those company earnings will be retained in those companies, and that'll increase the book value of those businesses. So you can kind of start to see why this is far from an apples to apples comparison. Let's go back to that Bloomberg chart. The 6-month Treasury bill is now in line with the earnings yield on the S&P 500, and this is the first time in more than 20 years that this has happened. And this is noteworthy, but does it mean that long-term investors should make any material changes to their investment strategy or allocation? I'm not too sure about that. So let's look at things simplistically. You have buckets for your money. The long-term bucket is for retirement and passing on wealth to your children and other selected beneficiaries. And then there's the short-term bucket, which is meant for your everyday cash, your emergency fund, college expenditures, etc. Those two buckets are managed very differently. So the takeaway is that, yeah, it's nice that short-term government bonds carry attractive yields again, but I wouldn't interpret this as some type of signal to make any wholesale changes to your long-term investment allocation. Now, if you were presented with making a safe 5% return for, let's say, the next 10 years, you might want to reconsider, but that is not at all what this is here. Who knows what yields on the 6-month Treasury will be 6 months from today? And that's when you're going to have to reinvest this, and that's appropriately called reinvestment risk. So let's take a look at the yield on the 6-month Treasury bill, so the aqua line, in 2006. It was about 5%. So let's say that you decided to just invest in that 6-month Treasury and then perpetually roll it over at maturity every 6 months. Well, look at that yield from 2009 to 2021. It was essentially zero for most of that period. So that would not have been a wise strategy for your long-term investment bucket. That's it for this week. Thanks for watching. We'll see you in 2 weeks.